Hello, everybody. Welcome back. Welcome to the last part of the series analysis of Hero Motors. So let's recap all the stuff that we covered, all these, all the previous videos. The first video, obviously, I introduced the whole, the methodology, how I analyzed based on the security analysis principles. Also introduced you to the security analysis study aid that I've created that's going to help you understand the principles if you don't have the book. Then we went over investment versus speculation. Again, this is a very important philosophy that you have to keep in mind when you are, analyzing because you have to always understand investment is all focused around factor of safety. Then we went over a couple of Buffett's words of wisdom as to how he and Charlie Munger have their mindset when they are analyzing any company for Berkshire Hathaway, and also uh, he how Mr. Buffett laid stress that a sound investment can morph into a rash speculation if it is bought at an elevated price. Berkshire is not exempt from this truth. So this is a really important concept where people ignore. They always think, "Oh, it's such a great company. I can just buy and at any price," which is incorrect. Even a great business, if you buy at a really higher value than its fair value, you're going to have a permanent capital of loss. So, people have seen that in the past with companies like even like Microsoft or Glance Industries also. So, one needs to be really, careful about the price they are paying, for the business they're investing in. And then we looked into the objective, like what was the objective for analysis? That is to figure out the important aspects of the business, and so that you can easily build around the factor of safety when you're valuing the stock. So we looked at the important things like how Hero Motors makes money, what are the its sales trends, how the industry has grown, what are the main parts of its financial statements, and also the important part where it has the financial disputes with the government authorities, and the how it is leveraged because of Eurofinance in the profit loss statement, the different expense line items we looked into, and also the cash flow and the different important footnotes we looked at. So after looking all this, now it's like, what next? What is the next step? So from here on, it's basically you are in charge. So we have gone through the annual report. We have weeded out all the important parts which you need to be considered. Now you get back into the main things that go around the valuation. So based on that, you have to make a judgment. What is the growth rate of the sales of the number of vehicles? What's the growth rate of the selling price per vehicle? The above two figures will give the net growth in the sales by the company. So if you multiply the number of vehicles into the number of selling price per vehicle, you get that. Then what's going to be the future operating margin? So all the different components we saw, the expense items, you have to all figure out that to come up with a margin, the margin rate. Then what are going to be the capital expenditures? So how the company reinvests to create more factories and all those things. Then a very, very important part is the excise duty rate, because that can really change the cash the company gets. So that has changed over years. So you have to figure out, a conservative one. And then the future tax rate we looked at, and the fair value of all assets and liabilities. So here again, we have to consider the contingent liabilities we saw in the page 150 because of the financial disputes with the government agencies. And above all this, an appropriate discount rate. So when you have all these nine items, when you plug them in a fair, like any valuation model, you can get a range of a fair value of a stock. So again, remember, A fair value is not a definite value. It's always a range. So let's say I'll give you an example. So if someone is trying to figure out, uh, like let's say age of a certain person, it's really difficult to determine exact age, but you can always predict a range. When you look at a person, you can at least say, is he or she, below 18, or is he or she below 80, above 80? You can at least get one or the two, right? You cannot have that, oh, that person is actually above below 18 and they turn out to be above 80 years or something. So it's like the range is more important because that's how the factor of safety you can figure out. So if you get the range and if the stock is selling way below the range, then it's pretty safe. So when you plug in all those things, you're going to get that. Now you might be wondering, how would I do that? So if you are not familiar with the investment valuation techniques, then I would definitely recommend you the textbook Investment Valuation by Damodaran. I have found it really valuable. It has all the tools. He has explained all the nuances. It's going to take you some time, maybe a week or so, if you spend a couple of hours every day to understand. At least in the first part, he has covered discounted cash flow valuation. I would highly recommend you to go over that, and he also has few videos on YouTube where he's explained that. So again, if you put all these things, you're going to get the fair value. So fair value range. Now the closing remarks. Okay, this is really important. Uh, First is valuation. Now, do not try to compare your valuation with any other person's valuation. Neither ask anyone else as to what they think is the value of the stock. Because the truth is, there is no right answer for estimating a fair value of a stock. It all depends on the growth rates that you assume. So, like, if you assume 30% growth rate for Hero Motors, you can value it for like 100,000 crores. If you assume 5% growth rate, you're going to value it 50,000. So it's like all plugging the numbers, and neither you nor the other person can know what exactly is the growth rate till when the future goes, till the company is gone through all the phases, and in like 10 years or so. So the thing is, there is no right answer. That's the point. Now, so there is no point comparing and figuring out. Now, the second really important thing is around stock tips. So a lot of people come to me and they ask, "Hey, should I buy this stock, or what should be the value of this?" I tell them just one thing: like, no one in this world has become a successful investor by following stock tips. No one. So, like Warren Buffett, or any other successful investor you see, they've all been successful because they do their own research and they follow their judgment. Because if you want to be a successful investor, you have to do the same. Say no to stock tips. Make your own investment decisions based on your own research and judgment, and you have to stick to it. So remember, there is no shortcut. You have to do all your homework. You have to go back. You have to figure out the factor of safety. Based on that, figure out a fair value, and have make an investment decision based on that. So I hope you found the series of the videos helpful. So if you have any questions, please mention them in the comments. I will certainly try to get back to you. And again, I would like to remind you about the disclaimer. This content of this video presentation is for education purpose only. If you decided to use it to making any investment decision, then you're doing at your own risk. So just want to give you a little reminder. And that's it from my side. Hope wish you all the best in your investment journey. And thank you for